You know when you see the market form that perfect V shape or that perfect A shape and you just know you're missing something? Well, you're not wrong. Those patterns are not random at all. They're actually a roadmap. And today we're going to decode that map by diving into a really powerful concept, reclaimed order blocks. Hey everyone, welcome to AI Explains ICT. In this video, we are breaking down the core ideas from ICT's core content, month 4, episode 7. And listen, you're going to want to grab a notebook for this one, I'm serious, because what we're about to cover will absolutely level up your entire understanding of order block theory. So, here's our game plan. First, we'll peek inside the market maker's playbook to get the logic behind all these moves. Then, we're going to decode the bullish buy model. After that, we'll flip it on its head to master the bearish sell model. And finally, we'll wrap it all up into a new trading edge you can start using. Okay, let's start with the big question. Why do these patterns even happen? I mean, before we can even think about trading them, we have to understand the why. What's the engine that's creating them in the first place? It all boils down to one word: size. The big players, the market makers, they can't just slam a button and buy $1 billion worth of something. The market would go haywire. So they have to be clever. To build a huge long position, they actually have to sell short at the same time to balance their risk and create liquidity. This whole process is a form of hedging. And this balancing act, well, it forces them to leave behind these super predictable footprints in the price action. And our job is to learn how to read them. And this is the real payoff. As ICT says, understanding this gives you, and I quote, X-ray vision into price action. Just think about that. You're no longer just looking at random wicks and candles. You're starting to see the actual structure, the intent behind the moves. All right, let's dig into our first pattern, the market maker buy model. Now, the core idea here sounds kind of backwards, but it's so important. Sometimes the market has to go lower before it has the fuel to go much, much higher. So here's what it looks like. It's that classic V shape. The drop on the left, that's what we call the sell side of the curve. Now, this is where the market makers are secretly, quietly accumulating their long positions. The big rally that follows on the right, that's the buy side. But the clues, they start appearing on that first move down. So, as price is dropping on that left side, you'll notice these little temporary bounces. The very last down candle right before one of those small rallies, that's a bullish order block. But here is the absolute magic. Once price hits its final low and starts rocketing up on the right side of that V, it will often come back down to that old down candle, reclaiming it as a brand new floor of support for fresh long entries. Okay, let's look at a real chart to see how this plays out. Focus on the left side of this V shape. You see those down close candles that cause those tiny little bounces on the way down? Okay, now follow the price after the major low gets put in. As the market rallies up on the right side, watch how it comes back down to test those exact same levels. It finds support and continues higher. That, right there, is a bullish, reclaimed order block in action. So cool. Now, if you understood the buy model, you're going to love this, because the sell model is literally just the mirror image of what we just learned. We just flipped the entire thing upside down. This is all about how price needs to climb higher before it can take a major nosedive. And here it is. The sell model forms this A shape or an inverted V. The rally up on the left is the buy side of the curve. This is where market makers are hedging and quietly building up their short positions. Then, after the top is in, the big drop on the right side is the sell side of the curve. That's where the real move unfolds. The logic, again, is perfectly inverted. On that first rally up, we're on the lookout for up-close candles that led to small temporary dips. Then, once the final high is confirmed and price is falling on the sell side of the curve, it will often rally back up to reclaim those old up candles as a new ceiling, a new area of resistance for short entries. And here's what it looks like on a live chart. Notice the rally on the left. And see those up candles that led to those little pullbacks? Okay, now look what happens after the peak. Price tries to rally back, but it slams right into those same levels, which now act as a solid ceiling, a clear wall of resistance. It's a textbook example of bearish reclaimed blocks. Okay, let's put this all side by side to really lock it in. With the bullish V shape, the goal is to go higher, so we watch the down candles on the first half to find our long entries on the second half. For the bearish A shape, the goal is to go lower, so we do the opposite. We watch the up candles on the first half to find short entries on the second. See? It's a perfect mirror. Okay, so this is all really fascinating theory, but the real question is, how do we turn this into an actual, tangible edge in our trading? Let's break down the practical steps you can start looking for on your own charts. Here's a simple 5-step playbook. First, you identify the V or A shape as it's developing. Second, you mark out those potential order blocks on that first curve. The down candles for a V, the up candles for an A. Third, you have to be patient and wait for that major turning point. 4, watch for price to come back and reclaim those levels you marked earlier. And 5, that's it. You can use that level as your high probability entry point. So if you only take one single thing away from this video today, let it be this. The two sides of the curve are a mirror image of each other. The market literally creates a roadmap for you on the first half of the move. That's not just random noise, it's the market telling you exactly where the key battlegrounds are going to be on the second half. Your job is just to listen. Hey, if this breakdown helped a light bulb go on for you, do me a favor and hit the like button and subscribe for more deep dives into these ICT concepts. And if you have any questions at all, drop them in the comments below. A real human will get back to you. Until next time, safe trading.